Hi, I'm David O. CPA. I want to talk to you today about your inheritance from your mom or dad. The estate tax doesn't apply to most of my clients, and the reason is the math doesn't work. To calculate a taxable estate if your mom or dad has died, add up all of their assets, subtract any liabilities like mortgages, add any gifts they reported on Form 709, and if the total is over $11 million, you will need to pay tax on your inheritance. So because of this, there is no inheritance tax for most of my clients. That 40% rate will never affect them. The problem is the hidden tax on your inheritance. This is something the IRS calls IRD, income in respect of a decedent, or income that hasn't been taxed yet. So we're going to talk about how these various assets get taxed in your inheritance. Well, let's talk about your parents' home first. Let's say they bought it in 1970 for $30,000, and on the day they died, it's worth $200,000. So we have a large gain hiding in that house. The nice thing about the inheritance tax is we get something called a step-up in basis. Even though mom or dad may have paid $30,000 for the house, because it was worth $200,000 at the date of death, the IRS says you can use that $200,000 as your basis, or pretend that is what you paid for it. This is the step-up in basis. There's also a step down. Basically, we need to know the fair market value of the house on the day mom or dad died, and for this, we recommend you get an appraisal from a real estate agent or property appraiser. So now that you've inherited mom or dad's house, what happens? Well, you spend $2,000 or $3,000 on repairs, you got to hire a real estate agent to sell the house, and by the time you're done, the IRS lets you add all those numbers together, the $200,000, your step up, your repairs, and commission, you got a $17,000 loss. Unfortunately, from the IRS's point of view, this loss on your inherited house is not deductible since it's considered a personal loss. The biggest mistake my clients make is to gift the house to their children using a quitclaim deed. Unfortunately, with a gift, your basis remains what your parents paid for it. If they paid $30,000 for that house, then you paid $30,000 for their house. And after they die and you go to sell it, you're going to have to pay tax on $170,000 worth of capital gains. About the worst mistake you can make tax-wise from our point of view. There may be other reasons for the transfer, but for tax purposes, it's pretty bad. The other problem is, what if your child is involved in a lawsuit? Your house could get hung up in that lawsuit, or if your child files bankruptcy, you might be forced to protect your house from your child's bankruptcy. So we don't normally recommend using a quitclaim deed to give a house to your children and leave yourself on the title. A beneficiary deed, however, is a better solution for the same exact thing. You want to leave the house to your kids. You can put their name on the house, but they don't own it until you die. So this keeps your name off the house, keeps any other problems from happening to the house until they're gone, and they get that nice step up in basis. They get rid of the income tax when they're ready to sell mom or dad's house. How do rental properties work? Almost the same exact way a house does. We get that step up in basis, which will get rid of the gain on the house, but we also get rid of that accumulated depreciation, which was waiting to be taxed. This is the amount we reduce your house by every year for tax purposes. This is a great inheritance for the kids, and it's a way to avoid that income tax as well from selling the house. So if mom and dad are struggling to manage the house, think about hiring a property manager. So they won't have to pay $30,000 to $50,000 in taxes when they sell it, and that will increase the amount that you're able to inherit. Moving on to IRAs. IRAs are something the IRS says has never been taxed. They are tax deferred. They come in lots of forms, 401ks, 403bs, etc. The beneficiaries will be taxed on every penny they cash out of these accounts. They've got up to 10 years to cash the money in, and they can control how fast it is cashed in. You could cash in $1,000 from the IRA this year and $10,000 next year, maximizing that lowest tax bracket you have. So when you're inheriting an IRA from mom or dad, be careful to see if you can keep your taxes in the lowest bracket possible. Now, if it's your spouse that's died, you can simply roll that IRA account into your own account. However, make sure you're over 59.5 when you do this. If you're less than 59.5, then you might be creating a penalty for yourself if you decide to get to this money early. Remember, there is no penalty for early withdrawal in an inherited IRA. So if you're 20 years old and you've inherited this IRA from mom or dad, the IRA company is going to put a code 4 on the 1099, which means there's no penalty when you cash it in. You just have to pay the tax. You can legally reduce your tax rate to 0 on your IRA account. How do you do this? By giving your IRA to a charity. Let's say that I put my wife down as the primary beneficiary of my IRA, but I put the charity down as my contingent beneficiary. That means when I die, the money goes to my wife. When she dies, we can give the money to the charity, and the charity isn't subject to income tax, so they can inherit my entire IRA account income tax free. If you plan on leaving some money to your favorite charity, think about using your IRA or 401k to leave that money to them so that you can cheat Uncle Sam legally out of the income tax. Let's talk about annuities for a minute. Annuities come in two main flavors, non-qualified and qualified. A non-qualified annuity is basically one where mom or dad takes a check from their checkbook and writes a check for 50 grand to the insurance agent to buy an annuity. Over time, they'll earn interest on this annuity, and if they die while owning it, and it's worth, let's say, $56,000 by this point, only the $6,000 in interest that has been earned on the annuity will be taxed to the kids, or the beneficiaries, if you will. So the $50,000 comes back tax-free because that was mom and dad's purchase price. That's not profit there. A qualified annuity, though, is like an IRA. Some people will roll over their IRA into a qualified annuity and is treated just like an IRA. That entire $56,000 is going to be taxable, not just the interest that was earned on it, because it's a qualified annuity. U.S. government bonds, stocks, and mutual funds are taxed a little bit differently. Let's start with EE bonds. These aren't as popular anymore, but a $50 EE bond, for instance, might cost $25 when you purchase it. But over time, it will slowly earn interest until it becomes worth that $50 face value. And beyond that, it may continue to grow. Let's say when mom or dad dies that bond is worth $100. Only the interest, the $75 difference between what they paid for it and what it's worth when you cash it in, is what's going to be taxed to the kids or the beneficiaries. For stocks and mutual funds, we have some different rules we play with. We have the step up and step down in basis. So we look at what mom or dad paid for AT&T or Disney, in this case, $1,500 and $10,000, and we look at what they were worth. AT&T was worth $30,000 and Disney was worth $8,000. So AT&T gets a step up in basis. It becomes worth $30,000 to the kids. If they sold it the same day mom died, they wouldn't pay any tax. The Disney goes down from $10,000 to $8,000. This is a step down in basis. And again, if it was sold the same day they died, there would probably be no tax due. So in this case, we've gone from a $20,000 basis for the parents to a $70,000 basis for the kids. That's $50,000 in capital gains the kids won't have to pay tax on. The only tax they'll have to pay is the difference in value between the date of death and the day they actually get around to selling the stock. So if you wait a couple of years, you'll need to keep track of this list of values on the date of mom or dad's death when you sell it. Cash, savings, CDs, other things. A checkbook and savings, tax-free. Just take the money out of mom and dad's account, stick it in the kids' account, there's no tax due. Cars and trucks, same thing. Jewelry, tax-free. Life insurance, tax-free, except for the little bit of interest the insurance company will pay you between the day mom dies and the day you cash in the life insurance policy. Maybe 20 or 30 bucks. So it's usually not a big deal. CDs might have a tiny bit of interest that hasn't been paid yet as well. Furniture, tax-free. Artwork, tax-free. Anything that's large or valuable, jewelry or artwork, I do recommend you get an appraisal for, because if you're going to hold on to that and maybe sell it in 5 or 10 years, you'll want to know what the value was on mom and dad's date of death, so that you only pay tax on the difference, how much it grew in value. Thank you for watching, and I hope I've answered a lot of your questions about whether or not your inheritance is taxable, and if so, how much. My name's David O, a CPA. Thanks.